So, welcome to today's presentation. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia, a registered investment advisory firm that works with Australians in the US and Americans in Australia. Today's presentation is on the art and science of determining how much of your wealth to hold in the US versus Australia. Do keep in mind that this does not constitute personal financial advice. That's something that I deliver to my clients, of course, and all material and information presented here believed to be from reliable sources. Our YouTube channel, so be sure to check this out. We've got a couple dozen presentations that are up, including last month's presentation on unlocking tax efficiency to do with moving your US retirement account to Australia and how that works. A little bit about me. So I was really born into this international and cross-border financial planning situation by way of being born in the UK, raised in Australia, and then moving to the US in my early 20s. And it wasn't until I got to the US, I thought, surely I'm not the only one in this situation. There must be a meetup group or a Facebook group or a book or something dealing with the issues that that folks with a cross-border financial life confront, and there wasn't. So I ended up starting Arete Wealth Strategists in 2012. By 2014, I was enrolled in a graduate diploma in financial planning in Australia. I'd already got my US CFP. I was teaching at Berkeley and Golden Gate. So very experienced as a US financial planner, but I've really had to do a lot of the research here on the US and Australian side. And I was lucky enough to be paired with a PhD candidate about 5 years ago, and I paid a stipend for him to do his PhD and was able to steer his research into the kinds of questions that we encounter here. So a lot of what I've got is proprietary research that we've been able to put together over the past 5 years and last 10 years as well. So that's a little bit about me. Who do we work with? We work with really three broad types of clients, and that would be the Australian business owner living, say, a globally mobile lifestyle between the US and Australia, wanting to take advantage of the opportunities that are there. The Aussie family that's moved to the US, actually, and I guess another variety would be the American family that's moved to Australia as well. So this is just a table showing you the kinds of goals and results that that these different client personas have had. And needless to say, the value that we deliver is a multiple of the fee that we charge. I already have a chat in here. Sky has got some. Hi, I'm an AI assistant helping Sky Hammer. That's interesting. So let me keep going here. Today's presentation, we're going to be looking very broadly at many different factors. How much to hold in what currency? That's what it's all about here. So in answering that question, we're going to be looking at taxes, exchange rates, expected returns. Some of the inputs into expected return, of course, is investment costs, restrictions facing US tax residents. That's why one of the key questions I always ask prospective clients is, what's your intention for your US legal status, your citizenship, for instance, going forward? And because the financial implications are profound. Estate planning considerations, and lastly, investment administration. All right, let's get into it then. So I actually was speaking with a prospective client last week who's located in Dubai. It's not their real names here, of course, but based in Dubai, and he's planning his move back to Australia next year. He already owns a house in Sydney, so that's taken care of. But he's got investment accounts in the US, the UK, and Australia. And the focus, just moving back here, the focus of the engagement for this client would be, I want you to provide advice on how I should consolidate my global portfolio. And that's perfect, because I said that's exactly what I'm doing a webinar on next week. And so the thoughts that came to my mind as I began to prepare for this meeting was what are the benefits of keeping your funds in the UK? What are the benefits of keeping them in the US? How might we best consolidate? What are the costs associated with these different investment environments? And what are the risks? What are things coming up? And what we know about the UK, it apparently Keir Starmer's Labour Party is the odds-on favourite to win that election, and he's indicated that he would get rid of these non-dom rules that now benefit certain individuals in the UK. That it essentially means you're only taxed on your UK-sourced income for up to 15 years that you're living there and claiming that you're not going to be there long term. So that's a rule that goes back to the 18th century, and they're about to get rid of that. So that's led to an interesting statistic. I was just reading this today, actually, from Henley and Partners. They're saying that the UK is now the second country in the world with millionaires fleeing. So there's been 10,000 millionaires already this year that have left the UK because they're afraid they're going to have to start paying taxes. So the Russian oligarchs are going to have to decamp to Dubai, it would appear. So interesting example, and I want to try and come back to this one as I go through today's presentation. All right. Really, the golden rule of where to hold the majority of your net worth is in your country of domicile. Domicile does not mean residence necessarily. It's a longer term version of the same thing. Domicile really means where do you see yourself living for the rest of your life? That's your country of domicile. And so the reasons why we hold this view are really to do with the risk management concerns. And that is, if you're living in Australia, your bills are going to arrive in Australian dollars. It's simple to access those funds. We don't know, especially in times of major turmoil, such as the global financial crisis, where exchange rates were in extreme volatility. We want to take that kind of guesswork out of it. And so with that in mind, I would say and do say to clients and prospective clients, you probably want the majority of your funds in your country of domicile. So for folks moving to Australia, that's going to mean in Australian dollars, or for individuals in the US, obviously US dollars. I was speaking with a prospective client this morning, actually, who's looking to consolidate their the mother is thinking of how she wants to her goal is to pass on her wealth to her son, who now lives in the US. She is not a US tax resident of any kind, and she was wondering, what the most efficient way is to do that. And that was a fairly straightforward answer to that question, and that is that for a non-resident alien, that's the charming term that the US use for a non-US person, to make a gift to a US person is tax-free. So there's no problem there. There is a Form 3520 that needs to be submitted so the US knows the source of those funds, so they're able to track it, but they're very happy to receive funds into the US. It's more getting them out of the US that's a little bit more complicated. So that was an interesting conversation that we had this morning. The other point to bring up there with the conversation this morning is the son, who's now based in Los Angeles, who has two young daughters, just like myself, who's settled there. I have to say, well, there's probably no point once his mother passes on for keeping funds in Australia. Is there a cost advantage? Is there a tax advantage? I could not see any advantage whatsoever to keeping $1 in Australia. And they said, well, what about buying an investment property? And I said, go have a look at some of the property commentators out there. I listened to Dr. Andrew Unterweger, who produces a great quarterly webinar. You can find it on YouTube. He spends more than an hour going through the different major cities and the drivers of demand and supply, and you'll see what I'm saying is exactly what he's saying, and that is the price of real estate has risen so much it has not been reflected in rents. And so to find a good cash flow positive property, you're really not going to find it in the major cities. You've got to get out to much less glamorous places in regional Australia if you want to see that. But anyway, I'm getting a little bit off course here. So the recommendation to the client this morning was that at his mother's passing, just move it all to the US. So what else do we have here? So risk management. I think in the case of the clients that I work with between Australia and the US, we don't have to worry about this. But in Latin America, this is a big consideration, and it is an exception to that golden rule. If you've got someone who's living in let's say Mexico, it's not necessarily political instability, but it would be the maturity of those laws and capital markets. Do you really want everything in Mexican pesos? There's been terrible stories of banks going under. Mexican banks, by definition, are not FDIC insured. So people have lost their life savings when such things have happened. But in any case, that doesn't really affect us so much between Australia and the US. Monica's written in, could you please confirm the name of the YouTuber regarding real estate? Yeah, Dr. Andrew Unterweger, we did a joint webinar back in December of 2022, but he's pretty active on YouTube, actually. Jody, although Australian currency low right now, to move it over to the US and interest rates earned on it. What? On it in Australia are now high. Jody, I'm coming to that. So there's a whole there's a whole section dedicated to that. So Dr. Andrew Unterweger, Unter Unterweger. Okay, so taxes. Let's talk about taxes. One advantage, one tremendous advantage, in fact, two tremendous advantages listed here for Aussies, not for Americans. Note that's why that's in brackets there for non-US tax residents. When moving back to Australia, there is this beautiful advantage that you can make use of, and that is the ATO views the basis of an asset acquired abroad. If you purchased your holdings in Commonwealth Bank or whatever before leaving Australia, you're away for 10 or 20 years and then came back, bad news. This does not apply to you. But if you purchased your NVIDIA or Google stock while you're in the US and then move back to Australia, the Australians take the view that we can't determine the tax basis of that asset acquired abroad. We're not even going to bother doing that. So what we're going to say is that the fair market value of that stock on the date you resumed Australian tax residency is your taxable basis. And that is a tax gift that you could barely believe, but it is true, and that's exactly how it applies in practice. And I've seen this many times before with clients, particularly those in the tech sector in Silicon Valley. They've got some RSUs or low basis stock that they were given back when the company went public. They're holding on to it. And I say keep holding on to it until you get back to Australia, because at that point you could sell and have next to zero in terms of capital gains. Does that apply to Americans? No, it doesn't. Why? Because Uncle Sam, he's got a very long arm and he wants to reach into your pocket and take that capital gains tax due when you get to Australia. The only way around that would be to expatriate altogether, but I would never recommend on a webinar. I would never recommend doing that without a deep consultation on one's individual circumstances. So the American doesn't gain from that, the Australian does. And interestingly, if we think about this in reverse, if you are an Australian who then moves to the US and settles in the US has a very unfair treatment of an asset, and that is they go back to the original basis. So Australia, remember, they say we can't be bothered, or we don't know any reliable way of determining what you acquired the asset for. So we're just going to say it's a fair market value on the date you resume Australian tax residency. The US don't say that. They say, no, we want to know what you bought your Commonwealth Bank stock for back in 1992, years, decades before you even thought of moving to the US, and we're going to tax you on that original basis. So not an advantage at all on the US side. Tax advantages, moving on. Superannuation. this is what I call the recontribution strategy, and I mentioned it in last month's webinar. So Australian tax residents, and note, this is not for the US person, as you see down there. There can be all kinds of unintended consequences with superannuation. It's like nitroglycerine for Americans when they're in Australia. So for Australian tax residents, there's really two opportunities that you can make use of. One is the 5-year concessional contribution carryback, which is worth $130,000 in the next financial year coming up in just a couple of weeks. So that's great for someone who's coming back to continue working in Australia. That means they could contribute up to 130 into super, and it entirely tax deductible. Don't forget there is a 15% contribution tax into super that the Australian system never likes to talk about, but there is a 15% contribution tax. And then separately, there's also a 3-year non-concessional contribution carry forward. So you can get up to 360,000. So for a couple, you're looking at 490,000 per person. So nearly $1 million into superannuation. And if you don't have those US ties, really, I go by the mantra that the location where you're going to get the best tax treatment is the most certain driver of returns. We don't know necessarily what investment returns tomorrow are going to look like, but if you can move your money into essentially a tax concessional account like superannuation, then why wouldn't you do that? That makes a lot of sense to me to do that. So thank you, John. You've saved me there with the spelling. So does not apply to dual citizens. Does not apply to dual citizens, I'm afraid. Libby, good to see you. Can you explain more about the 3-year non-concessional carry forward? Yeah. So there's two types of contributions well, there's actually three, but there's two, in 99% of cases, there's two types of contributions into superannuation. And it's analogous to a traditional IRA versus a Roth IRA. So the traditional contribution is a concessional contribution. In the current tax year, that's $27,500 that you can contribute into your superannuation account, and that will reduce your income by that much. Now, what this 5-year concessional carryback was about is the saying, well, if you didn't make full use of your concessional contributions, then you can take the unused amount for the past 5 years. This came into effect in the 2018-19 tax year. The non-concessional carry forward is more like your Roth contribution. So it's done with after-tax dollars. The formula for non-concessional contributions is 4 times the concessional contribution amount. So it's just about to raise from 27,500 in the current financial year to 30,000. So it's going to be $120,000 next year. And so there's the 120,000 of the current year, and then an additional 2 years that you can bring forward. So that's essentially what that is there with the non-concessional carry forward. Dividends, interest, and capital gains. So I've got a screenshot here from the IRS's technical guidance showing us Australia at the top of the list, what the appropriate withholding is for these various types of income. So for interest, it's at 10%. There's the treaty article citation. This is not Arete Wealth Strategists resource guide here. This is the IRS's that I've screenshotted. So, and what I've cut off because it's not relevant to today is the pensions and annuities, which is 0%, which is something I take great pleasure in conveying to custodians when they tell us it should be 15, 20, or even 30% that should be withheld. Actually, no, even the IRS say it's 0 and give the treaty citation. So for dividends, it's 15%. Why does this matter? Because if you have funds invested globally, you don't want to, especially if you're only a US tax resident or only an Australian tax resident, you don't want to have to file a tax return to get the appropriate withholding. These are the default amounts that will be withheld on your behalf. So dividends are sourced to where the company is headquartered. So when Google pays a dividend, they're obviously in Mountain View, California, and the US is going to hold on to 15% by default. If you owe more than that in Australia, then that's where the ATO has their hand out and says, please pay some more money. Typically, that would not be the case. Just a bonus question I've thrown in here because it came up 2 weeks ago in a client's case where he's receiving distributions from his Australian company that pays fully franked dividends. He said, "Well, what benefit does that provide me in the US?" And the answer is exactly none. In fact, it's somewhat of a disadvantage because if the company had paid fully unfranked dividends, then his distribution would have been higher, and then he's only paying that tax once, where he's losing that franking credit by being in the US. Interest is taxed to where the bank is located, so simple enough. I think everyone can figure that one out for themselves. Capital gains. This is interesting, and it's sourced to where you are located. So if you owned your Google stock and sold in the US, well, you're going to pay US capital gains. If you sold when you go back to Australia, remember the dividend was withheld on the US side, because that's how dividends are treated. Capital gains, different, sourced to Australia. So that would actually be a rare example where the Australian capital gains rate, assuming you had it for a year after you returned to Australia, would be long term, and the highest rate that would be taxed at would be at 22.5%. In the US, that could, at the federal level, that could be as high as 20% plus. We can't forget the net investment income tax, so slap another 3.8% on top there. And if you had the misfortune of still being considered to be a New York or Californian tax resident, then Gavin Newsom has got his hand out as well for some percentage there. So in the event that you're talking about a capital gain, a large capital gain, let's say $1 million capital gain in California, it's a rare case where Australia is actually significant, or New York, same thing. Australia is actually significantly cheaper for a capital gain of that amount because it's 22.5%, half of 45, the highest marginal rate that kicks in at $180,000, versus 23.8 plus your marginal rate in California, very commonly 9.3%, so in excess of 30% right there. So almost a 10% difference in capital gains if you're in one of these higher income tax states in the US. Exchange rates. So Jody, I haven't forgotten about your question there. So the first thing we need to be mindful of when talking about where to locate your funds is your cash needs. And I'm very often speaking with clients about what their situation looks like in the near term if they're moving. And this is where this kind of spreadsheet comes into it. So you've got the cost of your plane tickets, shipping your goods. Then when you get to Australia, in this example, you got to buy a car, there's some insurance policies, a couple months of living expenses, a deposit on a rental if you're not moving into your own property, and some furnishing costs as well. So, excuse me, in this particular example with someone moving from the US to Australia, you're going to need 82,000 Australian dollars. So whether the exchange rate's good or not doesn't really matter. This is a less discretionary kind of decision. But beyond the immediate needs, we need to think about the attractiveness of the investment and of the currency that we're talking about. We can see for the past decade or more, going back to 2011, actually, when the dollar was hit an intraday high of 112. The Australian dollar to the US dollar hit 112 briefly before coming back down. Really, the nadir we can see around the time of the COVID crisis was the high 50s, but we've been settling into this mid 60 cent range now for about the past year, with not much volatility at all in 2024. It's ranged, I think, as high as 68 cents this year, and not a whole lot lower than 64, perhaps is as low as what we got. What's driving that really is the demand for Australian dollars. Where's that coming from? From the export economy, which is primarily driven by the resource sector, which in turn is primarily driven by China and its appetite for Australia's raw commodities. There's also the education sector that's been picking up. The Labor government actually provided for the highest ever level of immigration into Australia. And so we're seeing a lot of people moving into Australia as well. So that's been a factor. And we can see at the bottom of the page here, this is from Westpac's economic forecast. This is not the Arete forecast, this is Westpac. So they're really seeing pretty much exactly what I'm thinking as well, and that is not much of an improvement. I wouldn't necessarily hang my hat on those 2025 numbers. They're seeing by the end of 2025 it creeping up to 71 cents. Maybe it will, maybe it won't. But I have yet to speak to anyone that's especially bullish on the Australian dollar, pegging estimates higher than what we're seeing here. So the time frame of the move is the time frame of the conversion is another factor. I hear from folks that they want to hold on to their Aussie dollars until the rate improves. It gets tricky when we're really not that bullish about an improvement. That's where the next coming up we'll talk about expected returns, but that's where interest rates come into it a bit more. On this slide, you can see here in the top half, I've got a table comparing foreign exchange costs. And needless to say, it always comes up. I am a big advocate of getting the best price you can on your exchange rate, but I think there is a subtle campaign of confusion that exists. I particularly blame Wise for this one, where people will say, I get a better exchange rate at this place or that rate. That's inaccurate language to use. The exchange rate is the rate. There is no better exchange rate that you get here or there. There is only one exchange rate, and that is what it is at this second and this second and this second. The difference is the spread from one foreign exchange provider to another. The lowest that I've ever heard of is with Interactive Brokers. They're charging a rate that's a fraction of a basis point. It's next to nothing. And you can see on $1 million, if you converted $1 million US, the fee the spread, that IB would be charging would be equivalent to about $30. The trouble with Interactive Brokers is it's the best and the worst simultaneously. The customer service is absolutely awful, but and the usability isn't much better than that either. But you get what you pay for here, and so you don't pay much, don't expect much either. We've negotiated, my firm and the GFP, the Global Financial Planning Institute, we've negotiated a rate with OFX, which is about the best out there on the retail side of things, and that's 30 basis points. So the interbank spread plus 30 basis points, that would be $4,500 on $1 million. So a massive difference with IB, but is the headache, the gray hair, and the stress in dealing with IB worth it? Once you've got it set up, yes, I think it definitely is, but getting to that point can be tricky. Some of the worst places to do foreign exchange is with your bank, and even if they flatter you by welcoming you to the private bank, banks are shocking with their exchange rates. With the spreads that they offer to their customers. Even private banks, literally the only thing I've ever seen a private bank do better than an RIA is be able to offer a mortgage on a foreign country secured by a property in a different country. That's a pretty cool thing to be able to do, but there's nothing else that they do that we don't do better. Down the bottom of the page, what I'm trying to illustrate here is the sensitivity of your converted funds to a difference in that exchange rate. So right now we're looking at today it's 66.5. It crept up a little bit overnight. But what if we held out with our $1 million that we had to convert? What if we said, you know what, we really want to hold on and wait till it gets to 68? I'm a big advocate of doing that because the exchange rate, as we saw, can be extremely volatile, and it was only a couple months ago that we did hit 68 cents. That is a return possibly to you that could be worth as much as $42,000 as you see down here. And so if you can keep your Australian dollars in a high interest savings account until such time that it's ready to convert, then I think you'd be well advised in doing that. So what do? We don't have a crystal ball, unfortunately, or if we do, then it's a little bit cloudy. So what we typically would say is for a permanent mover who's moving significant funds over, what we would try and do is set up a quarterly transfer. We set up a what's called a limit order. So we'd say it's going to trade if that rate improves beyond a certain threshold, and it's also going to trade if the rate worsens below a certain threshold, because we're trying to eke out every basis point we can for our clients' advantage, because the exchange rate is a far more leveraged and powerful influence of the money that you're going to get than what the interest rate is on a savings account. The chat seemed to be piling in, so I'm going to just go to those for a second. OFX is awesome. Thank you, Jim. Appreciate that. Scott writes, no one ever says that about interactive brokers, by the way, although it is and it isn't at the same time. Scott writes, if you push Schwab, then give you 0.3 and $1 million. That's true. You do have to negotiate, and that's something I'm often not interested in doing. You know, I'd rather just have it. Let's not play games, guys. I don't want to call you and say, hey, will you match what OFX is already doing for us? But I've heard the same thing. Katrina writes, if you should hold most assets on where you plan to live or retire, what if you're a dual citizen and don't know where you'll retire? My hubby wants USA and I. Yeah, Katrina, that's almost exactly the same as me and my situation with my wife, unfortunately. And the situation there, or my answer to that is flexibility is expensive. If you want to stay in this uncertain kind of, don't know where you're going to live, and you're dual citizens and whatever, then that's kind of the worst of both worlds. I mean, it's a blessing, and we're mindful that people are literally dying to get into the US, but if you're already a dual citizen and you have to figure out where you're going to retire to, then it's expensive trying to keep one foot in both camps. Sounds like that's John's situation too. Robert, Laura, yep, everyone's kind of agreeing here. Katrina, pushing for Oz. I'm pushing for Oz too myself. Paul, me too. Oz is better. Paul, and it all depends on where your grandchildren are. It honestly depends, right? We could sit here till the cows come home, negotiating the pros and cons of the different countries. Okay, I'm going to keep moving. Next, expected returns. Now, this section is titled expected returns because we are dealing with an unknown quantity. We have no idea what the future holds when something is invested. But we look to the thing that is more certain, and that is the costs and the investment environment that someone is confronted with. So what I've got here is a comparison. The blue line, GSPC, that is the S&P 500. The S&P 500 going back 20 years. So over the last 20 years, 390%. Compare that to the ASX 50 that you see here, and you see that's up 128%. So I am always, I take great pride, I don't know why, but I do. I take great pride in saying, when ignorant people talk about the increase in Australian real estate, and they say, oh, it's been absolutely unbelievable. It has been unbelievable. I'm not here to disagree with that, but it is nothing. It's not even 3/4 of what has happened on the S&P 500. The US stock market has absolutely smoked real estate globally. because while properties in major capital cities may have doubled, they may have even tripled, probably haven't tripled in over this period of time, but to see a 400% increase or near, as we see here, is really significant. It was only today Nvidia has surpassed Microsoft to become, and I think it was Amazon as well, to become the most valuable company in the world. AI seems to be largely an American stock market story. Australia's not participating in that at all. Australia's really still dealing in resources, telecommunications, and finance. That seems to be the bulk of the Australian economy. So the past is not prologue, as we've all heard before, but you can see here the US returns over the past 20 years have been very different to Australia. Alyssa's wrote, yep, UK, US, and Australia here. It's painful. Nancy agrees with Paul. Katrina, sorry, who was that last stock? I don't know what that's in reference to. Nvidia. Oh, Nvidia surpassed Apple. That's right. Yep. So interest rates. Let's talk about interest rates. So the US Federal Reserve ratcheted up interest rates at the fastest rate it has ever done in 2022. That kind of brought about a major correction to the stock market in 2022 and to the bond market. So it was a terrible year for diversified portfolios because of this. But we're at a point now in the US at least, and my family just arrived back in Brisbane this week. So now I'm seeing Australian prices for the first time in a year. And it seems to me like there is a bit of daylight between the inflation experience between Australia and the US. Inflation in the US has really calmed down. And we're seeing that in the news daily. We hear of Federal Reserve governors that will say that it's getting much closer to this 2% target. They're suggesting possibly only one rate decrease this year, versus in Australia where inflation's still not quite under control. Interestingly, the interest rate response from the Reserve Bank of Australia has been to keep things on hold here. So right now we're seeing almost a 1% variance between the US and Australian interest rates. So the US is at about 5.25% and Australia is just below 4.5%. And we see that reflected also here in these floating rate ETFs. So FLOT here, this is a VanEck Australian ETF. It's paying about 4.75% versus 5.8 for FLRN. This is a US State Street ETF. And it's not cash, it's floating rate, so it is invested, but this is indicative of the interest rate difference. There is, of course, most people are not going to be keeping excess cash invested in this way. If you're holding it in the bank accounts, I find the Australian banks to be extremely frustrating because they're full of these gimmick savings rates where you'll get this honeymoon teaser period, 3 months, 5.5%, but the base rate will be 0.5% or something like that. So you need to constantly be chasing the introductory offers. And your options are going to be limited if you're based in the US because you really are not going to be able to open a new bank account at a new institution if you're overseas. So you're limited to the offering that your bank has. Unless, of course, you're really smart and you have an interactive broker's account, you're able to move your money in there, and then you could invest in something like this FLOT, but not if you're in the US. Not if you're in the US, please hear that. You would instead get the 3.8% that IB offers on cash accounts. And why not in the US? Because this would be treated as what's called a PFIC, which we're going to talk about in just a moment. So you couldn't do it. Moving on a little bit. So every 2 years, Morningstar produces the Global Fund Investor Experience Study. They've gotten a bit slack since COVID. They do one a year, and now it's hard to keep track of when they come up with a new version. But 2017 was the last time they did all four attributes. There used to be a fourth attribute that they scored but they got rid of that. And that was sales environment. And Australia actually does very well on that front. I'm old enough now and have been in the finance sector long enough to have first spoken to an advisor in the early 2000s when I came into an inheritance and a settlement, and it was the Wild West. It was absolute garbage. Sales experience was what I was subjected to when I spoke with a financial advisor, and it was actually that kind of planted the seed for being a fiduciary and having someone, with a professional background be able to advise on an impartial basis. That what led me to becoming a financial advisor in the first place. But I digress. Since the Future of Financial Advice, which was a regulatory reform in Australia following the global financial crisis, and then the Royal Commission, Australia is actually considered to be one of the best regulated retail financial advice environments in the world. US, not so much. Just looking at comments now, Nancy's, with the increase in immigration in Australia, what's happening with renting? It's absolutely shocking, and I think it's going to get worse, Nancy. The uh, rents to affordability are terrible. The only thing worse than the rent to affordability is trying to purchase property. I just saw yesterday, I think it was in the Financial Times, that two of the 10 least affordable real estate markets in the world are in Australia, Sydney and Melbourne. Sydney is number two, second only after Hong Kong. I think it's going to be a political problem going into the future. If you cannot if you cannot buy a house, then what are you supposed to do? There was a stat recently in the US. There was a news article saying that something like in the past 5 years, a quarter of millennials who've purchased properties have done so with help from their parents. So it's becoming now a financial planning goal that I'm hearing from folks is I want to make sure my kid can buy a place, understandably. So something needs to be done. This really needs to rise up the political agenda. John writes, given the S&P 500 far outpaces the ASX 50, at least historically, if are returning to Australia and you have a decent US share portfolio, wouldn't you be better off keeping it there and letting it run its course? Well, John, guess what? Second slide today. This is not personal advice. This is, as my grade 11 English teacher taught me, this is where I am leading. I'm showing you, not telling you. So if you're drawing that conclusion, to me, that seems like a pretty good conclusion to draw. But I'm not telling you that. That's what you seem to be concluding. Libby, yes, experiencing the issue opening Australian bank. Yep. Steve currently broker cash pays 4.98. Where's Steve? Can you write back and say where is that? Where's that 4.98%? Paul, just in Australian, affordable rental and purchase are a huge state and federal issue. Yeah, you can say that again. John got it. Understood. Stephen Lindsay, USA. Where? What brokerage firm are you talking about? You're talking Interactive Brokers? Fidelity? That's not true, Steve. You'd need to be in a certain money market account for that to apply. And if it's the default money market account, the sweep cash, it's zero. It needs to, like at Schwab, for instance, sweep cash, zero. SNSXX, however, yeah, exactly. That's what I mean. So there's a big difference there, Steve. That's there has to be a warning label on what you just said. If you move it to a money market account, yes, you'll get that. If you don't, if you just leave it in cash, then you're getting a big fat zero. Okay, let's carry on here. So Morningstar does this report, and it's very helpful for us to compare investment environments. So on regulation and taxation, both the US and Australia don't do very well. And that's because we're comparing to countries like Singapore or Hong Kong, where there may be no tax. So relatively speaking, they don't fare so well. And I think, by the way, this bottom ranking for Australia, this is pre Royal Commission, Haynes Royal Commission. So Australia's moved up. I don't think it's bottom now. I think it's merely below average. Disclosure, strangely enough, the US does incredibly well. With the databases we have access to, you wouldn't believe the visibility that you can have to your fund Australians deserve better. In fact, it hasn't moved. Australia's appalling when it comes to disclosure, and we've probably all seen this in our super statements. If you compare the detail, the richness of detail that you can find on your US portfolio, say to let's say compare your 401k or your rollover IRA to your superannuation account, you barely know anything about how your super funds are invested. They might say growth stock portfolio. Well, do you own alcohol, tobacco, all manner of different sin stocks in there? You would have no way of knowing that on the Australian side. On the US side, you can find out what business school the secondary investment manager went to. You can find out the split of everything in your portfolio. Fees and expenses. This is interesting, and I've got some more slides to follow on this one. Both Australia and the US get a top ranking for fees and expenses, but there's actually quite a bit of difference when you look beneath the covers. Ben's written in, if you're a permanent resident of the US and want to spend 3 or so months in Australia every year and have properties and superannuation in Australia, you want to eventually access in 15 or so years, how do you optimize? Well, Ben, good to hear from you again. It's been a couple of years since I think we had a brief call. That's a fine question, and it's unfortunately it's too broad to answer in today's webinar. It's going to be tricky. You're going to have certain trade-offs in so doing, but you enjoy the flexibility of being, a citizen. You say a permanent resident. You enjoy being a resident, at least, of two of the most wonderful countries in the world. So let's look on the bright side there. Jody just wrote, you can open bank accounts online and get some great rates with Bank of Queensland and Macquarie and Capital One in the US. Not without the ID to be able to do that. So you may be able to open them online, but not unless you have, the appropriate driver's license or ID to be able to do that. The other thing is the devil's in the detail there. So the thing with Capital One, I love Capital One's credit cards, big fan of their Venture X card myself, but banking not as much. And one of the reasons why, perhaps a small reason, but I got burnt about 3 years ago. I had a client move back. He was an exec at Atlassian, moved back to Australia, and he had $4 million in Capital One. Well, guess what? They have a $100,000 a day wire limit. So it took us over a month, closer to 2 months, because it's business days, to move the funds out of Capital One because of that wire limit. So that's something we want to be mindful of when you're moving countries. So going a little deeper into this fees and expenses point, we see here, this is taken from the 2017 results. This is a little dated, I will admit, but there is quite a bit of a difference between the US and Australia, even though they're both rated as the top for fees and expenses. So when looking at median expense ratios for allocation funds, you could see the US is about a third less. And then for equity funds, was about half as much. So still quite a significant difference on the cost side in the US. Fund availability, you've got about 15 times as many ETFs. So if you want to if that's important to you, expressing your values through your investment holdings and being able to do so, having more product is obviously going to be an advantage. And then the overall grade that Morningstar assigns is to the US. That doesn't mean Australia's awful by any means. It's above average, but it is in second place. Other fees worth mentioning here that don't appear in Morningstar's report are to do with custodial and trading fees. So custodial fees include that's the fee for having your money at an institution. So you've got your money at NetWealth or Hub24 or E-Trade, CommSec, whatever in Australia, and they would say, great, thank you. We love you doing business with us, but just for you having an account open with us, we're going to charge you $500 because that's what we need to charge because this is a higher cost investment environment with all the compliance and and a much smaller population base to share this to spread the fees over. The US almost always $0. In fact, I don't know of any custodian, maybe with the exception of Pershing, Bank of New York Mellon, their broker custodian is Pershing. Sometimes they charge a custodial fee, but at Schwab, zero. Fidelity, zero. Most everywhere it's going to be zero. In Australia, like I said, it's going to be, or indicated, I should say, it's going to be about 0.1 to 0.3% just for the privilege of having an account open on their platform. Trading fees, while not a material cost for portfolios of 6 and 7 figures, it is a significant number, comparing zero to $48. So if you were to be in a what's called directly indexed portfolio in Australia, which I haven't heard of, and the reason I haven't heard of it is because it's cost prohibitive. Direct indexing is where you mimic or replicate an index, say like the S&P 500, and you're able to get exposure to that index in a manner that reflects your current holdings. So it's a pretty cool technology, and it works because if it costs $0 to buy stocks, you're not paying for 500 individual stock trades. In Australia, that doesn't even that would never even be heard. 500 times 50 would be a shocking trading fee just to get into to owning full all positions within that particular index. Mutual funds versus managed fund fees are fairly similar. At Schwab, you're going to pay about $24 for a managed fund. And in Australia, it varies. It's a little bit like how long is a piece of string, but they're similar on that front. Let me go back to the chat here and see what else we have. We use Capital One. We bill all our living expenses, to our credit card in the US. My hubby gets paid in US as well. Works well. Couldn't agree more. Yep, I think that makes a ton of sense. Thanks for looking at my question. You're welcome. Mr. DiCarlo, so where do US code? Jim, you're a funny guy. I know you know the answer to that. It's embarrassing. It's a bit like the Facebook answer, right? The Facebook is if the product is free, then you are the product. The answer is, how do the custodians actually make money? Well, it's a little bit of a sordid tale there. They make money by placement. So Vanguard and American funds and whoever they're the ones having to pay money to be listed with Schwab or Fidelity or whoever. There's also order information. I know Schwab does that. They're selling information to hedge funds, so they've got another revenue source there where they know what you're holding, they know what you're trading, and they're selling that information. So they've got a variety of other revenue sources out there. I honestly do not get worried about that hedge fund point I just made a second ago. And the reason why is the time scale of the investors is vastly different. These hedge funds are trading, in fractions of a second, looking for fractions of cents on differences. With the kind of clients I'm working with, we're investing for decades, and it just isn't a factor. Paul writes, don't want to go against the golden rule, but it feels like you should keep your long-term investments in the US and keep 2 to 3 years of living expenses in Australia to manage exchange rate risk. That would be one way of doing it. I don't disagree with you, Paul. Sky writes, takeaways from the meeting. I like your emoticons there. Research property market commentary from Adrian Underwood. Hold on, Sky, is this your AI bot confirming things here? Confirm spelling of Underweger's name, which is Unterwe, so not that I. And explain non-concessional. Yeah, okay. Thank you for that. How do we access OFX Arete exchange rate? You become an Arete client. That's how you access that exchange rate, Danielle. All right, moving on. I'm going to close that. Agree, Paul. Same conclusion. Yep. PFIX. Let's talk about this pretty quickly. Doesn't affect Australians, meaning if you're in Australia and you are not a US citizen, permanent resident, or you're not otherwise deemed a US tax resident by virtue of the substantial presence rule, then you don't have to worry about it. But if you are a US tax resident, bad news, and that is the PFIC rule will apply to you. And the PFIC rule is essentially saying that if you own a foreign managed investment, there's two rules that determine whether you have a PFIC, and that's the income and asset test. And that's the income. If more than 75% of the income is deemed to be passive, that's dividends, rents, interest, etc., you've got a PFIC. And if more than 50% of the assets produce passive income, you've also got a PFIC. Once a PFIC, always a PFIC. And PFICs are such bad news that it is one of the only, if not the only, tax rule I'm aware of where the actual cost of compliance very often exceeds the tax disadvantage. And the tax disadvantage is not small, which is to say that the compliance burden is enormous. The IRS, who are required to produce a time estimate of how long it takes to comply with their rules, they say per PFIC, not per portfolio, per individual holding, you're looking at 12 hours just to deal with that particular holding. So in other words, the short answer is if you're a US person abroad, do not hold foreign managed funds of any kind, ETFs, and even LLCs. There can be exceptions, particularly when people are investing in golden visa programs where there's no choice. If you go into it with eyes wide open, you can mitigate the damage, but at least you're doing it knowing what you're getting into. Okay. Lots of chat going on out there. Katrina writes, if you're a US citizen or Australian citizen, can you have a PPR in each country and get discounts? Can you have a principal place of residence? Yes, actually, you can, funnily enough. Although the Australian treatment is better because it's unlimited. The gain is unlimited. The US is 250 for a single file, is 500,000 for married filing joint. And sadly, that follows you to Australia. So if you've got a dual national couple in Australia and they have $1 million gain on their primary residence, Australia won't tax you, but the US would on that $500,000 additional gain. Gerald, good to see you. It's also been a couple of years. You only want to be a tax resident in one place at a time, true, but not so feasible unless, Gerald, you happen to be worth a bit of money, and then there's all sorts of interesting possibilities that come up on the US side where suddenly it's not as black and white as it is for most folks, where maybe, hint, hint, you could get back into the US using an E3 visa or some kind of investor visa and not have to deal with the long tail of the US following you forevermore. Okay. Yeah, I'm working that one out. Jim, how does this relate to investments in superannuation? What a fine question. Jim, I don't specifically address super here, but now that we're on this page talking about PFIX, let's talk about that. So, by the way, that's the topic of next month's webinar, is how to avoid the super tax. And I say super tax tongue in cheek, it's a double entendre because there is no extra super duper high tax, but how do you avoid the tax of being exposed by structuring your superannuation account incorrectly? The answer there is your super is either going to be dealt with in one of two ways. It's either going to be called a foreign grantor trust, which is not so great on the accumulation years, but it is good in the distribution years. Conversely, to have a super taxed as a foreign employee benefits trust, that's good in the accumulation years, not so good in the distribution years. That works fine for what I would say the most common client persona that I see is Aussies typically would go to the US, do a tour of duty, make some money on this labor arbitrage. That's the term I've taken to describe it, where many people, particularly in financial services and tech, less so biotech, but probably most commonly in tech, You just make more money for doing the same job in the US. Not only do you make more on a nominal basis, but you're making in US dollars, which is worth a third more than Australian dollars anyway, with lower tax, probably. So people tend to do that. They work for 10 or 20 years and then come back to Australia. If that's the case, then having a foreign an employee benefits trust is going to be great because you're not taxed on that while you hold the there's a superannuation account. And if you move back to Australia, relinquish, you've got no US status anymore. You never had to pay the US for your superannuation account. Conversely, if you've got a self-managed super fund or you've contributed more than 50%, or if you've rolled over your superannuation account while a US tax resident, or demonstrated too much control over your superannuation account, then it's going to be deemed a foreign grantor trust. Bad news, you're paying taxes on an annual mark-to-market basis on that, which is not great typically because you're in your higher income earning years in the US. And if you move back to Australia, you've got a stepped up basis that provided you no benefit because you weren't going to pay tax on that anyway when you were distributing that account in retirement. That would, however, be helpful to you if you retired to the US because when you're taking the distributions from your super account, you wouldn't really have any tax to pay because you've been paying it the whole time you've been in accumulation mode. Scott's written in, Australia will make you nominate one PP primary residence, I'm guessing, principal place of residence, to get the CGT exemption here. The other would be taxed as invested property. Yeah, that's a fair clarifier you put in. I just assumed that in Katrina's question. I was thinking you can only have one principal place of residence, but both tax codes will allow that to, well, I should say the US, because Australia wouldn't matter. You're not going to be a US, an Australian tax resident if you're not in Australia and you own a property in the US, wouldn't, unless it was through an Australian family trust, which would really be shooting yourself in the foot if you were to do it that way. With the exception of that, and I've never seen that before either, because that'd be really silly. That's right. They can apply in both places. Paul just wrote in, how long can you go home on vacation before Australia wants to make you a tax resident? Sadly, that's not such a simple question to answer. I've been thinking, Paul, about doing a short form video for YouTube answering that and talking about the tiebreaker provision in the tax treaty. The reason it's not a simple answer is because it depends on the nature of your US legal status. If you're a temporary visa holder, the answer could be different. If you own your own business, the answer could be different. That's actually fairly complicated to answer. But one thing I know I am not going to say is what was first floated in 2021, and that was a change to residency rules to make it a 45-day bright line test. Well, that wasn't even included in the latest budget, so we'll keep waiting to hear if there's any change there. Okay, dual citizen or retired. If you went back to Australia, I think okay, in the case of a dual citizen, it's probably going to come back to a tiebreaker situation, in which case, where do you have closer connections? So if you have your primary residence in the US, all your bank accounts, you own a business in the US, kids are there, and you're in Australia for 90 days, then I would say you're still a US tax resident. That can actually go on as long as 5 years in the most extreme examples, but it's all about having closer connections. Let's move on. Okay, so estate planning. This is all in service of answering this question as to where you should be locating your money. Estate administration, we'll talk about a step up in basis and transfer taxes. So estate administration, some people are going to be horrified to hear what I'm about to say here, and that is that if you have non-resident aliens, that charming term that the US used to use, they now use non-US beneficiaries listed in your will or trust or retirement accounts, it could take bringing legal action against your brokerage firm to actually compel them to pay out that money because they don't want to. The rules are so ambiguous and harsh that if they do something wrong, then they don't want to be held accountable. And I've heard this, by the way, from a specialist US international estate planner, Paula Jones, out of Pennsylvania. This is what she said to a GFP webinar last year. She said that this is how we have had to have estates settled, is you've got to threaten to sue them before they'll pay out. So that's very tricky. If you've got beneficiaries who are US folks who happen to live abroad, that's going to be quite a bit easier because the tentacles of the IRS are going to be able to follow those other folks a lot more easily. Basis step up at death. So let's talk about, and I did a series on this last year with Dylan Goldspring, talking about how estates are handled and different taxes that apply in the different countries. So when you die as a US tax resident, your beneficiaries get a step up in basis to the fair market value on the date of death. Great news. This is often touted as one of the better estate planning loopholes. It's not really a loophole. I mean, it's written right there. It's very clear. That's what it provides, but it's a little bit like the soldiers in battle. You have to pay the ultimate price to get that step up in basis. In Australia, not so much. However, I think Australia's got really good PR when it comes to how it deals with taxes at death and transfer taxes. And what I mean by good PR is they still tax it. They just don't use the words estate tax or gift tax. But believe me, there's still taxes that apply. So Aussies at death, their investment accounts don't get a step up in basis. No, no, no. Instead, the estate or the beneficiary inherits the basis. And the way that gift and estate transfers work in Australia is that everything is settled to cash. So if dad dies or mum dies and they've got this big portfolio full of wonderful Australian stocks and you inherit that, you don't do what you do in the US, which is simply transfer those stocks over into your account. No, no, no. Instead, you have to sell out of mum or dad's account, sell the cash. There's taxes to pay. Heavens forbid you're a foreign tax resident, because then you remember, and I've spoken about this ad nauseum, not only are you paying the non-resident tax rate, 32.5% from the first dollar, you also don't have the residence capital gains tax discount of 50%. So you're getting smashed with taxes if you're a foreign beneficiary. There's a way around that, but that's a story for another time, or a piece of advice for another time. So Australia, it gets settled to cash, and then the cash gets transferred, and you can go and repurchase that same portfolio that mum or dad held. Is this the same for cash? No, it's not. Cash is the only asset that is always at par. There is never gain in cash. There may be interest paid on cash, but that's taxable income. But cash itself is never a gain producing asset. Foreign exchange, you could say, was that an example of it? Maybe, but that's getting a little bit off track here for today. So gift taxes, under the banner of transfer taxes, a gift and estate. That's transfer, meaning you're transferring ownership of that asset from one person to another. That's a transfer, and that's going to happen either through a gift or through an estate transfer. For a US person, they're able to make transfers in two ways. One of which is $18,000 to any person, $36,000 per couple, obviously, per year. And that's indexed. It's been going up a little bit in the last couple of years with higher inflation. Or the other way is every US tax resident has I should say every citizen, not tax resident, citizen has a unified lifetime gift and estate tax exemption of $12.96 million in 2024, but it's about to sunset at the end of 2025, where it's going to come down to about 6 million. That's not set in stone that it's absolutely going to revert to 6 million. It's just the disgracefully dysfunctional government that the US has presently cannot possibly entertain dealing with such a topic, even though we're 18 months out before that actually happens. So that's something we need to stay tuned on and see what ends up happening with that unified gift exemption. So just to clarify this a little bit more, as a US citizen, throughout your entire lifetime, you can either give away up to $13 million during your life, or if you die, then your estate gets this same exemption to give up to $13 million to another person. In Australia, they don't have either of those things. Remember, they've got good PR for this. They don't have a gift tax, but everything has to be settled to cash. So the ATO doesn't miss out. They get to tax you when that settlement to cash happens in the first place. More chats that came in. So Danielle writes, if your dual citizen owns a US brokerage account and the spouse is Australian citizen only, is having an Australian will sufficient to do, or you need a US will? It's actually not even necessary at all, to be honest, because you're talking about brokerage account. You can set up what's called transfer on death instructions, TOD instructions, which in theory simplifies this a lot more. But Danielle, the scenario you pose is a tricky one, because that's actually what I began this whole section with, is if you are a dual citizen and your partner is an Australian citizen only, guess what? You're calling up Paula Jones and asking for her to sue Fidelity or Schwab or whoever to distribute that account to your beneficiary, even though they're the named beneficiary. Sadly, there's just sand in the gears on how that works. Typically, however, I'll give you a more expansive answer to your question. For assets in one country, yes, you want a will in that country that handles that assets. There is a convention known as the Washington Convention that allows for a so-called universal will, and I have met exactly zero estate planners that recommend that. Why? Because probate needs to be granted in serial order, and I've seen probate take a year or more in the US. And in Australia, maybe a little bit quicker, but you're talking about years before estates can be settled, when you could just have two separate wills, or even better, separate trusts, where it's going to be a lot quicker, and that serial probate sequence would not need to occur. So if my hubby's mother dies and leaves him 100,000, we'll be paying taxes in the US and Australia. Katrina, too much there to be able to even entertain that. Jim, can I gift into an Australian family? How to document? That is an interesting one. Okay, can you gift? Yes, you can, but as a US citizen, you're going to be subject to those same limits. So the 18,000 per year. If you happen to have a wife that is also on board with that gift, which you do, then you're talking about doubling that. Otherwise, you're using up your estate tax, excuse me, your unified gift exemption of 13 million in 2024. Ben, you're better to have a trust than a will to avoid probate. Absolutely. Absolutely. I actually was, I had a coffee week before last, before I left Minnesota, with a lovely estate planner. Thank you, Nancy, for the introduction. And I was reminded of this. It's actually good financial planning advice to recommend to someone having a trust. Not only is it good estate planning advice, it's good financial planning advice. And here's why, is because there's a probate fee that lawyers charge for assets that go through probate. If you're looking at a couple $1,000s to set up a trust where assets transfer directly from the trust, where you need only present a death certificate to say that person has passed on, the trustee then processes that transfer according to the language of the trust, and in the hands of the beneficiaries in short order. So not only is it efficient, but it avoids that probate fee as well, because it's not passing by probate, it's passing by contract. We have a trust in the US which bypasses estate probate. Well, that's what trusts do. Yeah, exactly, Katrina. Okay, so I'm going to close that and go back here. So estate taxes, similar story. So I'm going to dive into an interesting exception here. So US estate tax on Australian beneficiaries. We have an estate tax treaty. We have three treaties with the US. Australia has three treaties. There's the income tax treaty, the totalization uh, uh, treaty, essentially on Social Security taxes, and the third one is the estate tax treaty. And it is pretty good. Estate taxes is another one of these topics, not unlike the totalization agreement, where people, your friend at the networking event will say something that confuses the heck out of you. They say, no, no, that's not true. Non-resident aliens only have a $60,000 estate tax exemption on US situs assets. Situs is Latin for site of or where that asset is located. Uh, that's true. There is a $60,000 estate tax exemption for US situs assets for non-resident aliens. And that's bad news if you're Chinese or from any other number of countries where the US does not have an estate tax agreement. The reason I say Chinese is because very commonly the Chinese are trying to diversify their funds, get them out of China. They go buy real estate in Australia, and without the right estate planning, you're gonna they're going to be bitten by the $60,000 estate tax exemption. Doesn't apply to Australians though, because we have this estate tax treaty. And what it says is the Australian non-resident alien who owns US situs assets, the assets in the US, they get the full estate tax exemption. So it's really very generous indeed. Australia doesn't have an estate tax, but that doesn't mean there are no taxes that someone's passing. Again, we did a whole series of webinars on this last year. The reason I'm not going deeper into that is because the treatment for the primary residence, for superannuation accounts, and for investment accounts, investment real estate, it can all be quite different. An Australian estate can be complicated. Investment administration. Okay, we're going to talk about two things here, account closures and rebalancing. So a number of rules are on the books. There's actually one going back to, I believe it's 1971, the Bank Secrecy Act. And that's actually the original rule or law that forces you to file FBARs. It was sitting on the books for decades, wasn't really enforced. And then post global financial crisis, suddenly they came down like a ton of bricks on FBARs and FATCA. So it was really about 2010 that foreign compliance became a real thorn in the side to US financial institutions. And it's because of the SEC and FinCEN holding a cudgel over them that the US financial services sector is very, very leery of dealing with foreigners. Now, the attitude that any particular institution takes is distinct to it and it alone. So, for instance, Schwab loves Australians. They are totally fine. You can open an account with Australian ID having no US relationship whatsoever. Not the case, say, at Commonwealth Securities. Now, I hate to bring confusion into anyone's mind. Commonwealth is actually a broker-dealer in the US that has no relationship whatsoever to Commonwealth Bank of Australia. Totally different companies altogether. But Commonwealth used to love Australia. They changed their mind about 2 years ago. They sent out a letter, like many of these US financial institutions, and they said, we cannot support you any longer now that you're located in Australia. So they kicked out their clients. And this has happened to many, many different companies. They just don't like Australia and they'll close your account. So you got to be with the right institution. So it's really a case of new enforcement for old rules is what's behind that account closure crisis. Rebalancing. Why do I bring this up? This is because if you own, this is kind of to, let me see, who was the gentleman who was opining throughout here? Paul, I believe it was, Paul O'Keefe, who was opining about where it makes sense to hold your assets. The point I'm trying to make here about rebalancing is if you're trying to get an appropriately balanced portfolio and you own assets in Australia, in superannuation, maybe outside of super, and you live in the US, it's going to be really hard to do that, to rebalance across accounts with a unique set of investments available in one country versus the other, it is really darn difficult to be able to do that. So the point to do with rebalancing is just that it's a challenge to do it, and having visibility to your global holdings and understanding where you're duplicating exposures is tricky. So in summary, the pros of investing in the US would be it's the global reserve currency. Sometimes I have to deal with these conspiracy theorists who read an article on Fox News and say that the US is about to be dethroned. But while their share of foreign government reserves has declined, because they're threatened, China is threatened, Russia is threatened, North Korea is threatened. They don't like the ability the US has to be able to sanction them because they are the global reserve currency. So they're trying to de-dollarize many of their financial transactions. It's still by far the lion's share of world trade is done in US dollars. And that provides the US with what's been termed the exorbitant privilege that it has that allows to run these obscene budget deficits seemingly in ad infinitum. Possibly higher expected returns. We're comparing the S&P versus the ASX 50 over the past 20 years, and we saw quite a difference, about a 4x, 150% versus 400%. So a substantial difference to more than double the return over that period. Significantly lower investment costs in the US, vastly more fund choices, and a host of other differences that really you're just going to have to deal with on an individual by individual basis. Where can I learn more? Feel free to come to our website. Go to arete-wa.com. What's arete anyway? It's a funny sounding word. It's a Greek and a French word. I adopted it based on the Greek definition. It derives from Aristotle and refers to excellence of character and behavior. But Arete, that's how it's pronounced. You can get our key financial data sheet from here. We're updating. We're looking at a 24-25 financial year, so that'll be updated shortly. And next month's presentation is to do with avoiding the super tax trap, US tax rules for Aussie retirement accounts. So we're going to do a deep dive on that topic. If you're registered for today's webinar, then you'll receive notice of that one once the word goes out. But let me see how we're doing for time. Maybe there are questions that that the audience has. I'd be happy to answer it just for the next couple minutes. I'm just giving you a second to get those questions out. Right. All right, folks are maybe everyone got your questions out as the presentation was going. I like to do that to make it more interactive rather than just a diatribe, and also provide value to folks that show up live rather than on the recording. Melissa, as always, and thank you, Robert. Look forward to speaking with you soon. Thanks very much. Still processing. Yep, I imagine the wheels are really turning. Brilliant presentation. Thank you, Paul. My only ask for those that are attending here that are not clients is please don't keep me a secret. Oftentimes on Facebook forums, people will say, "Oh, this sounds like a sell," or he's trying to sell something. And I hope you've seen I do this to build goodwill and education so that people can make better financial decisions. But do spread the word if you know of someone that you feel we may be of assistance to. Thank you very much. Have a wonderful rest of your evening or day, as the case may be. And thank you, Melissa. All righty. Bye-bye.